Good morning. Welcome to the Street's opening bell here from Post 35 on the floor of the New York Stock Exchange. Today is Wednesday, the 16th of November. I'm JD Durkin. Opening bell rung moments ago. You know, I say the line every day. You think I'd get it right by this point? Every day is a challenge. Opening bell rung just moments ago here on the floor by OneMain Financial in celebration of their 100th anniversary. Congratulations, they are in order. The major indexes giving back some of yesterday's gains after another softer than expected inflation reading led to a pop in Tuesday's session. This morning, however, investors are reacting to strong retail sales data showing a resilient U.S. consumer despite surging inflation. Let's take a look at what's on tap for this morning's broadcast. We will be discussing the state of retail and consumer behavior as U.S. retail sales show significant gains. Plus, we'll be digging into Target earnings as the big box retailer warns of a grim holiday season ahead. And finally, we'll be breaking down the market impact of tensions overseas. And for more on those stories and so much more, we now bring in our senior editor and markets correspondent, Martin Baccardax. Martin, good morning to you. It's a busy one. And let's start with the biggest story of the moment, at least this morning. Retail, U.S. retail sales rose 1.3% in the month. That's higher than the anticipated 1% gain after there was no change in the prior month. What are some of your biggest takeaways from this report? What should viewers know if they're just waking up to this bit of news right now?
Yeah, it was a surprisingly firm number. There's no question about it, JD. But it has to be remembered when you are looking at retail sales as the Commerce Department publishes them, it's just a nominal number of receipts from all around the economy. And I say that to basically indicate that increasing gas prices were a big component of why we saw the gain. We had, of course, the spike up in prices in October. That increases receipts from gas stations and elsewhere. And as a result, that lifts the nominal level of retail sales value. So we did anticipate it would be firmer, but maybe not necessarily to this degree. What we like to focus on, JD, is something called the control group, which basically strips away gasoline, energy, food, building materials, and a couple of other things in order to try to get down to the core, if you will, of consumer strength. And actually, that number was firmer than anticipated. It was up 0.7%. The market was looking for somewhere in the region of 0.3%. So it certainly appears that there's resilience in the face of that inflation, although there's a couple of caveats in there as well that are worth mentioning, JD. The first is that, of course, we had the Amazon Prime deal event, which was brought forward into the month of October, and that undoubtedly increased overall receipts. We've seen other retail rivals like Target and Walmart bring sales into the October month as well. And there was a one-off tax refund in California that basically added about $1,000 to spending stimulus in the biggest state in the country. So those one-off events might explain the firmness, and they may cloud our understanding of consumers' ability to weather that inflation surge, which, again, despite the fact that it is decelerating, it's still at multi-decade highs.
The U.S. consumer powers nearly 70% of the overall economy. Help put this report into a little bit more context for us, Martin. What does it say about the health of the economy in the moment that we're in?
That's really what remains to be seen, JD. I really feel that this number needs to be sort of put into context of previous gains and what we can anticipate into the end of the year because of these one-off influences of both at the Amazon Prime Day and, of course, the refund in California. Again, it's so difficult to measure anticipated consumer spend because the behavior tends to shift very, very quickly as a result of perceived changes in the economy, either in the job market, in inflation, or indeed in gas prices. So it's fiendishly difficult to sort of pull out any directional movements from these numbers because of the rate of change that can happen as a result of these variances. So I would say the numbers suggest resilience, but not necessarily the kind of strength that's going to power the economy through and potentially avoid recession into 2023, because we're simply seeing more and more measurements suggest that that's indeed where we are headed.
If customer spending is high for the holiday season, it might end up being a good thing for retailers. But help me better understand this, Martin. Isn't the whole goal for the Fed, at least in part, to reduce our spending power? So break down if there's a little bit of two different priorities, maybe for the retailers versus maybe what the central bank wants, specifically in this conversation.
It's an indelicate science. There's no question about it, JD. And certainly the Fed, one way to put it is that the Fed would like to tame demand. They don't really necessarily like to put it in those terms, but we can understand why it is that we sort of digest and translate it as so. I think what they ultimately want to do is ensure that demand, as a result of maybe some artificial drivers doesn't overseed supply to a degree that becomes embedded into the economy. So if there is consumer demand that rises naturally from an economy that's growing, that's probably not necessarily a bad thing from the Fed's point of view. What they would be more concerned about is if wage increases were driving the ability for consumers to buy more goods whilst the economy was in decline, then that's a situation that would be pretty intolerable, not only from the investment point of view, but from the Fed's point of view as well, because that's the dreaded stagflation that many people are concerned about. So really, it's a contextual discussion, JD, about the underlying strength versus the consumer resilience and whether or not we're getting, and again, I'm simplifying to a great degree, good inflation or bad inflation. Right now, the Fed is concerned that we have a little bit too bad inflation as a result of these artificial factors. If inflation is more natural and organic from a growing economy, they're comfortable with that. At the moment, they are not.
I do want to pull up a quote here if we can. This is from a Morgan Stanley manager with regards to the PPI figure, and it says the PPI read certainly adds more fuel to the fire to those who feel we may finally be on a downward inflation trend. But goes on to say the market embraced last week's consumer downtick, and today's initial reaction, meaning yesterday's, seems to be a bit more of the same. So we do have two data points here, Martin, but 2 points only make a line, they don't make a plane. So what is the next big data point that maybe we can point to and say, now we've got a trend, now we actually have more of a substantive shift as opposed to just little pieces of anecdotal evidence?
Yeah, I think we'll need to see a couple of months of similar year-on-year declines and indeed month-on-month declines, JD, with numbers coming from November and December. So the clarity that markets will hope will be expressed by the Fed probably won't be evident until January or potentially even beyond. But I would certainly say that, on the face of the evidence that we understand and the arithmetic changes that we can predict in the measurements of both PPI and CPI, and indeed the PCE price index, which is the Fed's preferred measure, we're comfortable in saying that inflation is on that downward trajectory. Morgan Stanley itself actually published a paper earlier this week saying they expect inflation to slide below 2% by the end of next year. 2%, of course, is the Fed's preferred target. Now, that's an ambitious design, but I do believe there's some arithmetic sort of justification for it. But again, it will take a couple of months before this is sort of solidified or crystallized, not only in the market's point of view, but the Fed's as well. And I would imagine it will be early next year before we fully understand it. And unfortunately, JD, by that time, we could be staring in the face of a US recession. So the easing of inflation might be a welcome development from a market point of view, but they will then have to navigate weaker growth metrics at the same time.
So it seems like there's a pretty big guessing game going on, just trying to figure out really when the cycle of deceleration begins, right?
You're absolutely right. It's more about timing than actuality. Yeah. I think everyone is reasonably comfortable about the actuality. Now there's and this is great for markets and trading and investment opportunities because the timing for everyone is a little bit different. And if you can time the market correctly, of course, you can actually develop or generate the kind of alpha that investors would love to tell their clients that they can do. But again, this is more of a timing question rather than an event question, because I think the event is not in question any longer.
Let's just give another daily update, more or less, because I feel like I now ask you a version of this question every few days. The Fed meeting will be right around the corner, is right around the corner. What is the likelihood the Fed slows down rate hikes in December? The latest statistical probability.
Yeah, it's unchanged, oddly enough. For the past 2 or 3 days, it's hovered around that 80% mark. And by that, I mean traders anticipate an 80% chance of a 50 basis point rate hike from the Federal Reserve next month. Of course, they've raised it by 75 basis points 4 times in succession. That is the most aggressive cycle of tightening that we've seen from a central bank in this country's history. So it's a welcome sign that they're willing to sort of ease the pace a little bit. But again, as we say, the Fed's messaging hasn't changed as it respects to where they see the terminal rate, the ultimate end game for Fed rate increases. That's probably going to be somewhere between 5 and 5.25%, at least from the Fed's point of view. But if we get those decelerating inflation readings, JD, that number is going to drop very quickly, potentially down to 4.75 or even a 4.5 range. And if so, that will certainly add some underlying upward pressure for stocks.
All right, let's dig into some emerging tensions overseas after 2 Russian-fired missiles We'll be very careful with the language here. Russian-fired missiles landed in Poland. Reports confirm it was likely not an intentional attack on the country. Give us the market reaction to this, or top names to watch through the lens of investor sentiment, I wonder, Martin.
Well, I really think it was just one of those algorithmic situations, JD, where the trading programs see Russian rocket, NATO ally, and react in kind. When the humans took over and sort of understood a little bit more of the story, they were able to mitigate some of the declines. But overnight, you can imagine, with those word keys feeding into the trading technology, stocks paired gains. The dollar jumped very quickly as a safe haven defensive mechanism, and markets were just rattled a little bit by the assumption of what could happen in an already tense region. From what we understand, both from President Joe Biden's comments and indeed from briefings from NATO officials, it appears that the missiles, or the rockets, however you'd like to describe them, may have actually been implements that were fired from Ukraine missile defense systems rather than from Russian weaponry. In other words, whilst the Ukraine was defending itself against a rocket attack, and let's not forget, Russia is escalating its invasion of Ukraine, and it's becoming more deadly by the day. Ukraine's defending itself with indeed a missile system, and some of those went awry and therefore landed just about 4 miles across the border in a small town in Poland. So it's perfectly understandable why people assume this might have been a Russian rocket and reacted as such. But gratefully, the tensions, at least with respect to that, have been mitigated in overnight trading and were reflected again in futures this morning.
Yeah, of course. And I always like to say, Mark, whenever we have this conversation, obviously our job here, we're doing the show from the floor of the stock exchange. There is an investor angle and a business angle to everything. It certainly takes backseat to the humanity and the deep trauma across those communities. Of course, is that I just want to make sure we establish what the priorities are for sure. But since we do an economics focused show, that's where the bulk of our conversation will be. Back home in the U.S., we are continuing to see job cut after job cut, specifically here in a lot of the big tech names. What does that tell you about where the economy is right now? I think it's a fair question to wonder, did a lot of these companies, these tech companies, Martin, grow too fast? Did they grow too quickly and hire too many employees a few years ago?
That certainly seems to be the case, JD, and the numbers that we're seeing, whilst significant for the sector space, are probably not so significant for the broader economy. Goldman Sachs had some data out yesterday just indicating how small a portion the tech space is to the broader American workforce, and others rightly say that tech and STEM-focused employees who are let go from companies such as Google, potentially Apple, Twitter, and elsewhere, are going to be absorbed in other parts of the economy because their skills are so sought after. And it has to be remembered that there are about 11 million unfilled positions across the economy writ large as of the end of September. So there's no shortage for homes for the skills that many of these men and women possess. But of course, that doesn't necessarily ease the trauma of being let go in an economy that is downturning. But I do believe to some degree what we are seeing in the job cuts in the tech space are probably, and again, paradoxically and rather inhumanely, going to be seen as positive, because they will basically show us evidence that tech companies are reducing their expenses.
We're gonna work together. Martin, give me 1 second. Your audio just very briefly cut out. We're gonna do a quick reset here of Martin's audio. Martin, do you have me? And can you do a live mic check? I got you back. Okay, so it's really just that last sentence we lost. I'm sorry, Martin.
Yeah, I just feel that to some degree, and again, this is an inhumane and sort of grim way to look at it, but if companies are cutting jobs, they're probably making their stock values more attractive by reducing the cost base into headwinds that are expected into 2023. So this might actually end up being market positive, even though it's a little bit of a not a head scratcher. It's probably not as worrying for the economy as we might imagine, but nonetheless, the optics of job cuts of this size, particularly when you're looking at tens of thousands at Amazon, are not particularly comfortable reading.
Are you surprised to see this happen for so many big names at once? It's Meta, it's Twitter, it's Lyft, it's Amazon, and who knows who may be left for the next few weeks and months as the economy continues to shift and kind of change a little bit. Are you surprised to see so many big names going through it at the same time?
Yes and no, JD. I think getting into the end of the year and the tax implications of getting some of these redundancies off the books are probably one of the drivers. But in my experience, companies are notoriously bad at managing their human assets. They have always overhired and understaffed, depending on the cyclicalities of the market they're in. It's no great criticism of the men and women that lead these companies. It's just exceedingly difficult to plan properly and to have your workforce in balance for market conditions. And even more so now that we're seeing so many wild cards from China to Asia to inflation to supply chains and everything else. Add to the headwinds that many companies are facing. So it is a little bit arresting to see these all together. I think the end of year component is one, and I just think traditionally companies have had a very difficult time managing properly the people that go up and down the elevator in companies each and every day. And this is just another example of that.
You know, as counterintuitive as it may sound to a lot of people out there, the Fed in part is looking more, I don't know exactly how to phrase it here, but not exactly looking for unemployment to raise, but that's going to be a bit of a sign that the economy is cooling and moving in the right direction here. So the Fed has said in the past that a softer labor market is needed to ease some of these inflationary pressures. Yeah. I don't quite want to phrase it as if to say this is what the Fed wants, but how should people kind of square that circle between, on the one hand, understanding these are lives and livelihoods of men and women in these workforces that are going to be changed for quite some time, while also keeping the balance of the Fed's clearly stated goals to help bring back prices down?
Well, this is exactly why the economics is described as the grim science, JD, because that's exactly right. You have the human condition that can't be argued, but at the same time, as we all know, in the world that we live in, there are no free lunches. It's impossible to have full employment without the kind of faster inflation that would eventually lead to difficulties for people at the lower level of the income scale. And it would, to some degree, mitigate the gains that they've made by being in employment. So there's never a perfect condition and a perfect balance for all of these metrics, whether we're talking about inflation or growth or unemployment or anything else. But your point about the Fed and its outlook for the job market is certainly pertinent, given the fact that they anticipate headline unemployment will rise to about 4.4% by the end of next year. That's a really big increase from the mid 3% level that we're looking at right now, and would certainly indicate the likelihood of recession in the world's biggest economy if the Fed proves to be correct. But again, the fact that there are so many unfilled positions that remain in place in the economy, even as it begins that gentle downward trajectory, you do wonder whether or not, firstly, the Fed's projections are going to be correct, or whether or not unemployment is going to have the same sort of menacing predictory factor for the economy as it has in the past, because we have had so much mismanagement, not only of human resources, but also because the pandemic and the work from home dynamic has changed the nature of work in such a way that it's more difficult for us to understand as a result.
All right, let's head into earnings here. Target posting a big miss in that company's third quarter. This as high inflation weighed on its results. Surprise, surprise, that's the case for many. What else do we learn from the retailer, Martin?
This was a really grim basic talk, no question about it. Their earnings basically halved from last year and were well south of street expectations. They came in at 154 per share, and that was a big, big miss. On a revenues perspective, they actually outperformed, but only just, to about 26.5 billion US dollars at the top line. Really, what they have been concerned about is a shift in consumer habits, which they anticipated, but actually accelerated maybe beyond their expectation. And the fact that we are seeing the implications of the inventory overhang that they suffered from over the summer. So there was deep discounting to shift that inventory, and they were somewhat successful. That ate into their margin. There was a change in the consumer habit down to more value-priced goods, which is significant for Target because its discretionary items tend to compete at a higher price point. And then, of course, there was the headwind of consumer price inflation across the board. Furthermore, JD, they don't have the kind of grocery sale component at scale that rival Walmart does. So they weren't able to establish market share there, or indeed grow it and offset the weakness that they saw in discretionary at the higher price point. So put it all together, and you had a really difficult reading for Target, a muted holiday quarter outlook, a planned cost-cutting program which didn't provide detail but said it was going to save about $3 billion. And you roll that into the market anticipation, and you've got a stock that's down probably between 12 and 15% at the start of trading today.
So now, having laid that out, remind us what happened with Walmart, and then help us better understand why that same thing did not happen with Target.
Really, I think it's about the value proposition between the two. In other words, Walmart competes at a lower price point and has a much broader offering in the grocery market. And as a result, they can bring customers in on grocery and then offer them discretionary items that are at a lower price point. Collectively, that allowed Walmart to have significant gains on the revenue side. They were up about 9%, if I remember correctly, to about 153 billion US dollars. And they also saw light margin improvement. Now, what they also saw was a better rundown of the inventory overhang for the summer for Walmart. That differentiates to Target, where there was inventory rundown, but not nearly as quickly. They have higher price points at the discretionary end, which makes it more difficult to compete, and they don't have grocery at scale. So those are the main differences between the two. Oddly enough, Walmart's outlook wasn't particularly spectacular. They actually, whilst they don't expect earnings to decline as much as they thought in the summertime, they are going to decline, and they don't see comparable store sales rising as fast as investors had hoped. So it's interesting to me that both Target and Walmart weren't particularly sort of optimistic about what they expect for holiday spending. A lot could change between now and the coming weeks. But whilst Walmart was not punished for that muted outlook, Target, because of its execution, most definitely was.
So just remind us here, Martin, as I take a look at the calendar, we are somehow 8 days out from Thanksgiving. That's incredible to think. It was just January. I don't know where the whole year went. What are other data points or pieces of information that someone like you will be closely following? What are you anticipating to give us a better sense on what the holiday shopping season will look like in this conversation? Are we awaiting big information? You know, I know we got the Fed meeting coming up in about 2 weeks, but what else are we looking out for?
Really, that's the next great sort of hurdle for the markets to clear, that early December Fed meeting. But you're absolutely right to say that most of us are going to be focused on what kind of information comes out of the Black Friday sales, the weekend shopping activity, and then again, Cyber Monday. All of those events used to be sort of bifurcated in a way that we could look at them on a standalone basis, but I don't see that as the case any longer. I think for the most part, companies are blending in their sales, both from an online and in-store perspective, over the whole of that holiday shopping season, and indeed beyond into the end of the December weeks. So we won't have the fullest understanding on the Monday afternoon and the Tuesday morning that we might have had in the past. So we'll have to pick through those details with a little bit more sort of delicate precision. I do anticipate they'll be modestly stronger than we expect, because I do think particularly companies that have food offerings will be able to entice customers. But I'll be interested to see the difference between online and in-store traffic, and potentially what we are expecting from the mall-based retailers. And we'll get numbers from Macy's and Kohl's and a couple of others later this week to give us an indication of what they expect as well.
At this point about earnings, we will hear from NVIDIA after the bell today. What are some of the main points that you will be following there, Martin?
The gaming sector is one of the most interesting ones, JD. They, of course, produce graphics cards for gaming consoles for companies all around the world. And it's a big component of their earnings, and indeed a growing one. But it has seen significant weakness this year. And their anticipation for gaming chip demand going into 2023 will certainly be interesting. And whether or not the chips that they make for data centers will be able to offset that weakness, I think that sort of bifurcation is exactly what investors are looking for today. NVIDIA had guided down over the summertime with respect to its growth metrics, not only into this quarter, but into the end of the year as well. We'll see if we can get any update on that. And NVIDIA is just an interesting benchmark company for the chip sector that many people are going to look to when they give us their forecasts, because they have been reasonably accurate in the past. Underneath that, JD, this morning we had a warning from Micron, which also makes chips, but in a largely different sector and sectors than NVIDIA. They're going to cut their production for DRAM and flash memory chips by about 20%, and they see slowing demand for that into 2023 because of inventory buildups as a result of the pandemic. So the chip sector itself is looking quite weak at present. So it will be very interesting for investors to hear what NVIDIA has to say about its specific sectors, data center, gaming, and artificial intelligence. And furthermore, JD, what they have to say about the export restrictions on high-tech chips to China, which has only just come into play over the last couple of months.
Yeah, it has. It's certainly a big priority for the space and a closely watched company, and they report after the bell, and I'm sure this will be one of many things we'll talk about on tomorrow morning's show. Okay, time now for our rapid fire here to finish out our broadcast. First up, Mr. Martin, building back better. What's behind Lowe's? There we go. Words are tough. What is behind Lowe's strong Q3? There we go.
That's a very strong Q3. There's no question about it. Similar dynamics to what we saw with Home Depot yesterday, JD. When you have this downturn in the housing market, you have a counter-cyclical buffer inside the Lowe's business operations. And that's the fact that people are going to rebuild the houses or repair or refurbish the houses that they live in to either maximize the potential selling gain or to stay in them a little bit longer. So there was an upturn in demand, and that gave Lowe's the chance to beat street forecasts, both at a bottom line that came in at $327 per share and on revenues, which came in just over $23 billion. They boosted their profit outlook for the year as well as a result of this Q3 beat. They narrowed their expectation for sales, but they didn't lower it into the final months of the year. And I think just leveraging off the back of what we saw from Home Depot, the stock got a firm kick this morning.
All right, on to number two. Is the FBI closing in on SBF? I think I know what that's referencing.
SBF, FTX, FBI, we're just drowned in acronyms, aren't we? What we've got here is the several reports that say that Sam Bankman-Fried, who was, of course, the CEO of FTX, which filed for bankruptcy last week and has sent ripples through the cryptocurrency market, is going to be extradited to the United States. This has not been confirmed, although I am seeing reports in major media organizations here in the U.S. and indeed elsewhere. But essentially now the acrimony is piling up with respect to this, not only bankruptcy filing, but the impact that it's having on crypto markets writ large. We saw this morning that Gemini, which is part of the crypto complex run by Tyler and Cameron Winklevoss, who of course famously went up against Mark Zuckerberg for the ownership of Facebook about 10 to 15 years ago, they've frozen withdrawals in their lending operations as a result of the dislocation that we're seeing both in Bitcoin and in broader crypto markets. We're hearing that from some smaller players as well, and we're seeing a decline in Bitcoin prices as a result. So this is by no means over. And of course, the Chapter 11 proceedings have just begun. Bankman-Fried himself is still making public comments, not only on Twitter, but indeed elsewhere, with interviews in major American newspapers. Lawyers find that astonishing. I find it a bit ridiculous myself, but he's still talking. And ultimately, that might be why we're seeing these reports about possible extradition to the U.S., because there are so many questions. And despite the fact that he's made all these statements, he's failed to answer virtually all of the most important ones.
Yeah, what an incredible story in a moment. It's something we all will continue to follow. Oh, wait, did I miss one here? My producer going to be so mad at me. Martin, I got to go back before this one. Number two, which is actually now number three for this morning show. What is behind Apple's big chip shift? I could hear him in the control and being like, JD, you come on, man. Okay, what's behind Apple's big chip shift, Martin?
I really thought this was interesting, JD, because we talked about it briefly yesterday. That's Taiwan Semiconductor, the biggest contract chip manufacturer in the world. We talked about the fact that they are building a plant in Arizona that they say is going to have about 6,000 people working in it at peak. And it is going to supply chips to Apple as a result of Taiwan Semi's relationship with the iPhone seller. Now, Apple, according to reports, one from Bloomberg and a couple of others, is going to now begin sourcing chips from Taiwan Semi's Arizona plant starting next year. Now, this is an important pivot because it will reduce Apple's reliance on supply chains in and around Asia. They're trying to put some manufacturing bases in India. They're making some chips in-house as well. And they're also now, at least according to this report, going to take some chips from Arizona. This is almost exactly the kind of thing the U.S. government is looking for in developing the CHIPS Act and enticing companies to make these semiconductor products here in the United States. And it's important for Apple as well to diversify its supply chain and certainly wean itself off the dependence of the Asia region that it's had for a number of years now.
Fourth and final, everyone knows what this next and final topic is. Donald Trump, am I pronouncing that correctly? Trump? I believe I am. Donald Trump officially running for president again. Will he win?
Will he win? That is just such an impossible question. It feels, I read very briefly an editorial in the Washington Post this morning, and I thought that they nailed it. They essentially said that the magic doesn't seem to be there in the way that it was when he began his first and, of course, historic run for the presidency in 2015. I'll caveat, JD, by saying that back in 2015, the mainstream media didn't see the magic either, but it was certainly evident in the rallies that he was having all over the country. And mainstream media probably should have seen that wave coming, even though because they were in denial about it for so long. It's such a different dynamic now that it's difficult to say that his chances are as strong as they were back then. He has the potential primary challenger in Florida Governor Ron DeSantis. He is losing the faith of some senior Republican Party members. I thought it was interesting that Mitch McConnell made statements to that effect last night, only a couple of hours before the former president's address in Mar-a-Lago. So it's a different world in 2023, 24 than it was back in 2016. But as we often say, he's not the kind of guy that you want to bet against.
Yeah, absolutely not. I'm just waiting for when he's back on Twitter. As you were talking, I was going over to Twitter, be like, he hasn't been allowed back on the platform yet, right? No, he hasn't. But remember, that's something that Elon Musk has said he has. That's when I think things really kick into high gear, because right now there is this separation between Trump, not tweets, whatever they're called, on Truth Social, and the vast majority of journalists that aren't on that platform. So there's still kind of a muted barrier between him aggressively shouting everything out that he wants, but if and when he's back on Twitter, now you've really emboldened him and his candidacy the way that he had at his disposal a few years ago. I'm already exhausted to think about the fact that it's officially 2024 electoral season. I think we all need a nap before we dig into it. We all need to catch up on sleep. Martin, a fantastic show, a fantastic conversation. Thank you as always.
Thanks, JD.
Martin is the reason we all get that much smarter every morning here on the show. And that is going to do it for the Market Open here from the floor of the NYSE. Stick with the street for more on these and all of the major market stories that matter to you. We'll see you tomorrow.